What is an FSA? Hi, this is Kathy Bukowski. I'm the owner of CB Health Insurance. In today's video, we're going to answer that question. What is an FSA? Let's start by saying, what does it stand for? It's flexible spending account, not savings account, and not to be confused with an HSA or an HRA. It's a flexible spending account. So under Section 125 of the Internal Revenue Code, employers are allowed to set up Section 125 plans, also known as cafeteria plans, for the benefit of employees to allocate money on a pre-tax basis for certain things. What are the certain things? Well, there's really three categories, major categories. One are premiums that you pay for healthcare, right? Typically health insurance, but it can be dental and some other things. Number two is unreimbursed medical expenses. Number three is daycare. So the first one, premiums for healthcare, if the employer doesn't pay 100% of the cost of your health insurance, you can do that on a pre-tax basis. And a lot of employers will set up only that section, right? Only the premium, and it's called a premium only plan. And this is kind of a no-brainer. Why wouldn't you want to pay pre-tax for your premiums, right? Number two is unreimbursed medical, and this is where the F.S.A. comes in. Employees can allocate money on an annual basis to be used for unreimbursed medical, and it gets put in a flexible spending account. Okay, number three is kind of it's daycare. They're allocating money for the use of daycare expenses. Now they have added a few other things over the years, but these are really the primary ones. So let's talk about what are the rules for FSAs. Well, first and foremost, we mentioned this earlier, the employer is setting this up for the benefit of the employees, and there are non-discrimination rules. So the employer can't do it for the benefit of themselves and or highly compensated people. So they're going to be limited, the owners are going to be limited how much they can contribute based on, the rank and file and people underneath them that set it up. Number two rule is the employee then allocates on an annual basis what their medical expenses will be, and you want to be conservative here because that annual contribution is going to be use it or lose it. So you either use it or lose it. Now, they are going to take that annual contribution out of your paycheck. Whatever the annual is, they divide by the number of pay periods and they take it out. The employees then can access that money throughout the course of the year for any unreimbursed medical expense. So for example, let's say that somebody has $1,000 of annual medical expenses that they pay out of their own pocket. If you didn't have an FSA where you can allocate pre-tax and you had to pay these expenses after tax, and let's just assume you're in a 30% tax bracket, you have to earn over $1,400 to make $1,000 after tax at a 30% tax bracket. So think about this, just $1,000 a year, you're saving over $400 in taxes. And oh, by the way, who is saving on the taxes? The employer is saving as well as the employees because it's on the match, the FUTA-FICA match. So the next thing is, yes, you have to use it or lose it, but there is a carryover. You can add into the documents that somebody can use it for the first 3 months of the year. So you want to estimate conservatively what you think you need. Now, what are the eligible expenses? The eligible expenses are anything that you applies towards your deductible, your medical deductible, co-insurance, right? After the deductible, there's usually, you're splitting the bill with the insurance company, 80% is paid by them, 20% that's co-insurance, right? Co-payment, you go to the doctor and you pay a $35, $40 copay. That's out of your pocket. RX copays, you're filling prescriptions, you're paying a copay. That's unreimbursed medical expenses, okay? Also vision and dental. Now, some people have dental insurance, but we all know dental insurance doesn't cover 100% of the bill. So you have deductibles, copays, and out-of-pockets on dental too. And if you're getting contacts and glasses, again, insurance doesn't cover this at 100%. Now, last but not least, they added some new things, and over-the-counter never used to be a eligible reimbursable expense out of an FSA or an HSA. they added this with the CARES Act for certain things. So what are they? It's allergy medication, cold and flu, stomach remedies, and menstrual products. So tampons and all the fun things that women need, that they spend a lot of money on, are now eligible to be reimbursed out of the F.S.A. account. Now, who sets up these accounts? Well, it's really the employer has to set it up for the benefit of the employees, but they hire a TPA. TPA is a third-party administrator who does this. They're going to charge a fee to the employer, and it's usually a monthly fee by the number of participants in the plan. But remember, employers are going to be saving 7.65% on the matching. So not only is it a benefit for your employees and possibly the owners, depending on what the limits are that they can contribute, but it's also a tax savings for the company that usually ends up in a wash, or the cost of setting up this plan is less than the savings that you're going to have on all of these deductions on taxes. So keep that in mind. What is an F.S.A? Flexible spending account. It is set up by an employer. They hire a TPA for the benefit of the employees. The employees can allocate money on an annual basis, use it or lose it, for unreimbursed medical. But tax savings can be both realized for both the employee and the employer. We hope you found this video helpful. Until next time, Kathy Bukowski, the owner of CB Health Insurance. Thank you for watching.